Hello everyone. Welcome back to our channel where we discuss all things finance and investments. In this video we'll be discussing the difference between cash flow and capital gains. As an investor, it's important to understand these two concepts because they play a crucial role in determining the profitability of your investment portfolio. While both cash flow and capital gains are ways of making money through investing, they are fundamentally different in nature. Cash flow is the amount of money that comes in and goes out of a business or individual's account. Cash flow is critical for businesses and individuals to meet their day-to-day expenses and obligations, such as paying bills, salaries, and debts. It is also essential for reinvesting in the business, such as expanding operations, buying new equipment, and hiring employees. Capital gains refer to the increase in the value of an asset or investment over time, such as stocks, real estate, or artwork. It is the difference between the purchase price and the selling price of the asset. Capital gains are important for investors looking to build long-term wealth. Importance of cash flow and capital gains. Cash flow is important for meeting short-term financial obligations, while capital gains are important for building long-term wealth. Investors need to consider both cash flow and capital gains when making investment decisions. Assets that generate consistent cash flow, such as rental properties, can provide steady income over time. On the other hand, assets that have the potential for significant capital gains, such as growth stocks or cryptocurrencies, can offer the potential for high returns. Types of cash flow. There are two types of cash flow: positive cash flow and negative cash flow. Positive cash flow is when the cash inflow exceeds the cash outflow, resulting in a net increase in cash. Positive cash flow is crucial for meeting financial obligations and reinvesting in the business. Negative cash flow is when the cash outflow exceeds the cash inflow, resulting in a net decrease in cash. Negative cash flow can be a warning sign for financial trouble, as it may indicate that the business is not generating enough revenue to cover its expenses. Types of capital gains. There are two types of capital gains: short-term and long-term. Short-term capital gains come from the sale of an asset held for 1 year or less. Short-term capital gains are taxed at the investor's ordinary income tax rate, which can be higher than the long-term capital gains tax rate. Long-term capital gains come from the sale of an asset held for more than 1 year. Long-term capital gains are taxed at a lower rate than short-term capital gains, which can make them more attractive to investors looking to build long-term wealth. Sources of cash flow. Cash flow can come from various sources, including operating activities, cash generated or used in the day-to-day operations of a business, such as sales revenue, expenses, and taxes. Investing activities. Cash generated or used in investments, such as buying or selling assets, property, or securities. Financing activities. Cash generated or used in financing activities, such as taking on loans, issuing shares, or paying dividends. Sources of capital gains. Capital gains can come from various sources, including stocks. The stock market is a common source of capital gains, as stocks can appreciate over time. Real estate. Real estate can also appreciate over time, resulting in capital gains. Collectibles. Collectibles, such as artwork or rare coins, can also appreciate over time and generate capital gains. Business ownership. Business owners can realize capital gains from the sale of their business or from the growth of the business over time. Advantages of cash flow. Provides stability. Cash flow generates a steady stream of income that can help individuals and businesses meet their short-term financial obligations and maintain financial stability. Easier to predict. Unlike capital gains, which can be volatile and unpredictable, cash flow is relatively stable and can be forecasted more accurately. This makes it easier to plan for future expenses and investments. Generates passive income. Cash flow from rental properties or dividends from stocks can provide a source of passive income, allowing individuals to earn money without actively working. Disadvantages of cash flow. Limited potential for growth. Cash flow investments, such as rental properties or bonds, typically have lower rates of return than investments that generate capital gains, such as growth stocks or startup investments. Limited appreciation. Cash flow investments do not typically appreciate in value over time, which means they may not provide the same long-term wealth-building potential as investments that generate capital gains. Advantages of capital gains. Higher returns. Capital gains investments can offer much higher rates of return than cash flow investments, particularly in high-growth industries. Appreciation. Capital gains investments have the potential to appreciate in value over time, providing an opportunity for long-term wealth building. Tax advantages. Capital gains are often taxed at a lower rate than ordinary income, providing tax advantages for investors. Disadvantages of capital gains. Volatility. Capital gains investments can be volatile and unpredictable, with the potential for significant losses as well as gains. Risky. Investing in high-growth industries or startup companies can be risky, with a high potential for failure. Requires active management. Capital gains investments often require active management, with investors needing to stay up to date on market trends and company performance. And that concludes our discussion on cash flow versus capital gains. As we've learned, cash flow and capital gains are two distinct ways to generate income from investments, each with its own advantages and disadvantages. While cash flow investments provide a steady stream of income, they may not necessarily result in significant growth over time. On the other hand, capital gains investments offer the potential for greater growth but may not generate any income until the asset is sold. It's important to understand your investment goals and risk tolerance when deciding which approach is right for you. A diversified portfolio that includes a mix of both cash flow and capital gains investments may be a prudent strategy. We hope you found this video informative and valuable in your investing journey. If you did, please give it a thumbs up and subscribe to our channel for more videos like this. Thanks for watching, and we'll see you in the next one.